What is credit? Well, put simply, credit is an agreement to purchase either goods, services, or financial assets with the promise to pay at a later point in time. Take a moment to reread that because this applies to all forms or tools of credit you'll come across: mortgages, personal loans, credit cards, and more. Now, is credit debt? Sort of. Say you have a credit card with a £1,000 credit limit and use it to purchase a brand new phone costing £1,000. With a credit card, you have an agreement where the lender has given you an amount of credit in exchange for the promise that should you use the credit, you will pay back at a later point in time. So in this example, you have now used £1,000 and so in a state where you will need to pay it back. The £1,000 credit has turned into £1,000 of debt. Credit is not debt, but when it's used, it immediately turns into debt. This isn't all. Another factor to know is not only does that £1,000 of credit become debt, it becomes, and by extension you become, an asset for the lender as you now owe them that £1,000. This may seem obvious to some, but being aware of this will help you be more equipped in dealing and understanding how lenders work, in particular with minimum repayments, interest charges and fees. Lenders of credit, whether that be a bank, credit card company or other party, offer credit on the basis of risk, and so these companies want to establish someone's level of risk so to not have or reduce the likelihood of someone defaulting. Methods they use to establish this and mitigate that risk are being on the electoral roll, having a credit history, paying on time, if you have defaulted or not paid your balance, and if your income level is sufficient for the level of credit you're requesting. These are factors you can change and influence to be seen as less of a risk or more trustworthy, as this will make a party more likely to extend credit to you. The key point to finish is, why is credit important? Credit will impact some of the largest purchases you'll do as they will require some form of credit. The biggest example would be a mortgage, and being seen as creditworthy can give lower interest rates which could be worth tens to hundreds of thousands in the long term. More generous terms of credit cards in rate special offer lengths, rewards and credit limits. If you have bad credit, you may not be able to get car insurance at an expensive rate. The same with phone contracts and personal loans. All these factors and more are why credit and being creditworthy is hugely important. The key points to take from this are: credit is an agreement to purchase goods, services or financial assets with the promise to pay at a later period of time. Credit immediately turns to debt for you and an asset to the lender when used. You want to work to make yourself appear as low risk as possible to be offered credit. If you enjoyed this video or found it useful, be sure to press that like button, click subscribe and hit that bell notification, and I will see you in the next video.